The second example that we're going to look at is that of a bond that pays coupons. Let's see what pieces of information we can extract from this word sum. A bond is trading at $185,000. So immediately we know that the price of this bond is equal to $185,000. The bond has a face value of 175,000 and pays coupons at a rate of 5% per year. The bond is redeemable at 105% of par. So remember that the redemption value of the bond does not necessarily have to equal the face value of the bond, but it will always be expressed as a function of this par value or the face value. So in this specific example, the redemption value is equal to 105% of the par value. We know that the term of the bond is 10 years. And now for the ask. So the question says that your client requires a yield of 10% per annum. And it asks us to determine whether this is a viable investment opportunity given this minimum hurdle rate of 10%. This is a tricky question, and I threw it in on purpose so that you can really understand what's going on here. So remember that a bond is traded on a bond exchange, and the price that is listed on the bond exchange is the price you will pay for this financial instrument. In other words, the price that you will pay to receive the coupons plus the redemption payment at the end of the term. So these values are specified by the terms and conditions of the bond, and they won't change. This is the guarantee that is given by the government. The term is also pretty fixed, except that when you buy this bond closer to maturity, the term would obviously be less, and the value of the outstanding payments would also be less. Now, the two values that will change on an almost continuous basis is the price and the yield that is implied by that price. Now, if you think about this, it means that the lower the price that you can pay for this given cash flow stream, a given coupon rate, and a given repayment rate, the better your return on investment or your yield will be. So the approach we need to follow for this question is to compare the market price to the price that the investor is willing to pay for this instrument. The market price is given as $185,000, so we already know what this value is. Now, to calculate the theoretical value that an investor would place on this cash flow stream, remember coupons at 5% per annum plus a repayment value. We simply discount these payments to the present day at the yield that the investor requires. I've already explained to you that the higher the price that you have to pay for this given fixed cash flow stream, the lower the yield will be. So, as an example, if you pay a really high price for this instrument, the resulting yield will be very low. On the contrary, if the price you're paying for this cash flow stream is low, then you'll get a very high yield or return on your investment. And we can draw a curve that looks something like this. So the theoretical price that we calculate will be somewhere along this curve. For the sake of illustration, let's just assume that T represents the theoretical price, and we know that that is calculated at a yield of 10%. Now there are two scenarios that can unfold here. If the market price is more expensive than what the investor is willing to pay, let's just assume it's at this point M, then we know that the yield is going to be lower than that required by the investor. Let's just call it 3% in this scenario. So clearly, when you have to pay more, in other words, when the market price is greater than what you are willing to pay, then this is not a good investment option because your return on investment will be lower than what is required by the investor. The second scenario could be that the market price is lower than the theoretical price required by the investor. And you can see that this will result in a higher yield. Let's just call it 15%. So when the market price is below the theoretical price that you're willing to pay, this is a good investment, since it will yield a rate of return of more than the required rate or the hurdle rate. So the easiest would be to draw a timeline for this problem starting at year 0 and ending in 10 years' time. Each year will receive coupon payments. We've worked those out at 8,750 each at the end of year 1 and at the end of year 2, etc., all the way up until the end of year 10. We will also receive a redemption payment at the maturity date. Now I'm going to break this up and first do the present value of the coupons using an annuity formula. We can write this as 8,750 discounted for 1 year. And remember, the yield that we will use in this equation will be the minimum rate of return that our investor needs on these cash flows. The second term will be 8,750 discounted for 2 years at the hurdle rate, plus, and then we have some intermediate terms, and then finally we have 8,750 discounted by 10 years, which is our final coupon payment, again at the hurdle rate. We can rewrite this by taking out the 8,750 as a common factor from all of these terms. Then we are left with v plus v squared plus and so forth plus v to the power 10. This term in brackets should look familiar because this is the formula for an annuity that pays $1 at the end of each year for the next n years. And those payments are made in arrears. So in other words, we have a timeline running from 0 to n. At time 1, there's a payment of $1. At time 2, there's a payment of $1 all the way up until time n minus 1. We also have $1 and the final payment is made at year n. This is the definition for a level annuity in arrears over n years. And we can use that to calculate the sum of the terms inside of this bracket. So we have 8,750 multiplied by an annuity over 10 years at 10%. Recall that the formula for an annuity in arrears over 10 years is 1 minus v to the power n divided by I. And if you work this out on your calculator, you get $53,764.96. The present value of the redemption payment is pretty straightforward. We just use our present value formula. The redemption payment being 183,750 discounted by the term of the bond, which is 10 years. Again, at the hurdle rate of 10%, and this works out as $70,843.58. Finally, the price that the investor is willing to pay for this investment is then calculated by adding the present value of the coupons to the present value of the redemption payment. Adding these two yields a present value of 124,609 when you round it. Remember that the bond is currently trading at $185,000 on the bond exchange. So what we need to do is to compare the price that the investor is willing to pay against the price at which the bond is trading. Now, clearly this price of 124,000 odd is a lot less than the price at which the instrument is trading. Remember, this is just a theoretical number that the investor would need to pay in order to earn 10%. But since the actual price is much higher than this theoretical price, we know that the investor will not be able to achieve his 10% target by investing in this particular instrument. If you did accidentally purchase this bond, the investor would earn 4.7% on his investment instead of the required 10%, so you might get into a bit of trouble. It's been an absolute pleasure to work with you through the basics of bonds. I hope that helped you. Please feel free to leave any comments or suggestions, and please tell your friends to subscribe.